Hi, nice to meet everyone. My name is Virginia. I'm part of the investment team at STRZ. We are a global VC or early growth fund. We invest globally, so we have offices between US, Europe, and in Asia. And we invest between Series A and Series B stage. So our ticket typically range from $10 to $30 million. We are a proud supporter of the travel tech system. We have a few investments ranging from amenities here in Europe, OTA Insight, Canary Technologies in the US, and we recently also launched and promoted an initiative called Travel Tech Titans to put a spotlight on the best travel tech startup in the world.
Oli.
Hi, I'm Oli Corkhill. I run Viadi group, so we're strategic travel investors. We started running Leo Trippy, which we've had for over a decade, and then decided to start investing in other travel businesses. So within the last 2 years, we've bought a tour operator as well as 2 vacation rental agencies, one based in the US, one based here in the UK, and sort of headquartered in Switzerland, but I'm here in the UK.
Thank you, Oli. Phil.
Yeah, so I'm Philip Lólis. I'm on the investment team at Thayer Ventures, also early stage fund focused on travel and hospitality. And prior to that, I also was a rentalpreneur, not in short-term rentals, but I had about like 20 to 30 cars rented in my hometown in Miami, Florida, but joined the dark side now.
Thank you, Philip. Nam.
Thanks. So Nam Quach, I look after the consumer leisure team at DC Advisory. We're a mid-market investment bank. Dealing with transactions probably between 50 to 500 million. Short-term rentals, big space for us. Staycation generally is a big space for us. So we advised Vitruvian on buying Sykes cottages. We sold regional cottages to Travel Chapter last year, and yeah, sort of big interest in both travel tech and the platforms involved in the space.
Excellent, thank you, Nam. My name is Simon Lehmann. I'm running AJL Atelier. It's a consulting firm in the short-term rental space. We work with private equity, we do M&A, we do consulting and advising, and we have a research division. We do a lot of market research. We help tech companies and PMCs for expansion, and we're based out of Switzerland. We're a team of 10 around the world, and we live and breathe vacation rental. I happen to be in this space for 20 years, so we love vacation rental, and I'm super excited to have you here. So let's get this kicked off. Obviously, we got reminded very clearly by Henrik what's going on out there, and I think we're all very aware of it. And we have now seen some data that shows that softening is happening. We need good owner relationships. We have more demanding customers. We have quite a few challenges to navigate. And I want to sort of set this off, especially considering the panel consists of 2 VCs, 1 advisor, and 1 strategic. It's actually a perfect mix to sort of get different views from the panel, what excites them about this industry. And Virginia, I would like to start with you, how A-Roads looks at this industry, what gets you excited about short-term rental and vacation rental?
Yeah, as we've seen also from the reports, vacation rental specifically also in Europe is one of the subsectors that is continually up and growing. And this is driven by a mix of cultural shift as well. We see many more companies also allowing flexible working policies. This is as an influence for sure, that we see many more travelers that are not seeking just an hotel experience, but a more home, away from home experience, which is something different. In terms of opportunities, there are now, I believe, hundreds of platforms in Europe ranging from the pure marketplaces, such as the Holido or Home2Go in Germany, that are helping these trends. But we are quite excited also about all the potential infrastructure play. So, for example, last year we invested in a company called Amenities, which is a all-in-one PMS solution for independent hoteliers and property managers. If you think about property managers, typically they might not be as tech savvy as other people. Some might be, some might not. So they need all the help they can get for all the managing of their bookings, but not only for the managing part, but also for the pricing strategy. We see a rise of revenue management system, for example, focusing on the short-term rental industry to support the property managers also in their pricing strategy. We see a rise also in distribution partnerships, so that's a subsector we are actually looking a lot into it. This is also fueled by the, let's call it the Gen Z revolution, because they have different demands from previous people, and so having and finding platform that can support also the demand of Gen Z is a trend we are looking into it.
How does Thayer Venture look at that?
Well, so I think I agree mostly with everything that Virginia said. I think one thing that I'm particularly interested in, mind the U.S. perspective, but I think that consolidation is pretty inevitable in the industry. It's so fragmented, and this gets me really excited. I think another place that we're very interested in is similar to how the hotel tech stack has kind of evolved from Muse to sort of this guest management suite growing on the cloud on top of that. We've made an investment in a company called Operto, which is building out that guest management suite. So I do believe that we're going to go from a lot of point solutions in the space to a more consolidated tech stack at the top as well.
So you're referring mostly to tech stack when you talk about consolidation. What about supply?
On the supply side as well, I think in the United States, I think 1% or less than 1% of all vacation rentals are managed by the largest player, which I think is Vacasa at the moment. And so if you think about that, on the flip side, hotels are about 70% controlled. 70% of all rooms in the United States are run by the big six, like Marriott, Hilton, Hyatt, IHG, etc. So I think that consolidation on the supply side is pretty inevitable as well. And we've started to see a rise in propcos in the United States that are trying to, attack this angle. We haven't made any investments in that space quite yet, but that's somewhere I'm actively looking.
And I got Oli. You're having a go at this, and
Sure.
I think one of the numbers were in Europe, the biggest four combined have like less than 2% market share. They've been around for 60 years plus. I ran a company that was founded in 1965, and they've been going at it for a long time. And now you, as a strategic, are having a go at it. Do you think supply can be consolidated from an M&A standpoint?
Yeah, sure. I mean, I think that's what we're trying to do. We started with our business Leo-Trippi, which is super niche, very, very high-end ski chalets, predominantly in the Alps. And we were looking at it thinking we've reached a certain scale, where can we go from here? We've got these clients who are very loyal to us, especially at the high end. And we started looking for what targets we could have and where we can cross-sell. So we bought Where to Stay in Texas to get into the Caribbean, and our focus is really on whether we're getting new supply in different markets. So whether that be looking at the Caribbean or Asia, or new geographies of customer that we can add in. So it's a little bit more narrow and focused on how it can support our existing businesses and our skill set. So that's the way we come at it. But yeah, I definitely think it can be consolidated, especially in the high end where we are.
Yeah. So you're in a very specific focused niche of the market as well, right? So
exactly.
I would definitely support that as well. So now, from your lens and how you're looking at that market, obviously you've been involved in some of the larger deals in our industry, and let's be honest, there's not that many out there, right? So, and there's not going to be that many coming our way. How do you look at the market overall, from a tech standpoint, but also from a supply and maybe from a demand standpoint as well?
So I think from the supply side, I agree. I think UK is pretty consolidated already. I mean, most of the big four have made a number of bolt-on acquisitions. Big four now, big three. It'd be interesting to see, whether Europe is next in terms of the next wave of consolidation. It's a much more fragmented market than the UK. But where we're most excited, and we're seeing a lot more activity, where overall M&A is down, is in the tech side of things. Travel tech is very hot right now. We've been looking at recently a business called Guestline was sold, it's a PMS system for hotels. A lot of interest in that business. And actually, from our work in that particular sector, what we can see is overall that sector is ripe for disruption. There is a lot of legacy and inertia to move. And I think I'd say with the right investments, the right partners, I think there is that whole travel tech side is very exciting.
So Viadi, coming to you, talking about the significance of scalability and profitability as well, right? So we've clearly heard also your focus in your VC business is more on the tech side as well, and supply is going to be definitely very challenging to be further consolidated as well when you manage properties, right? But how, like we hear this all the time, there's a lot of startups out there, we're seeing over 420 tech companies in our space, struggling for market growth and profitability, and raising capital at the moment is literally impossible if you have, not certain KPIs that the investors are looking for.
Yeah, for sure, the bar is now higher compared to 2 or 3 years ago. We are not in 2021 anymore, unfortunately, from that standpoint of view. I think there is a difference between stage of VC and when VC are investing. So if you look at the early growth, so from pre-seed or to seed round, it's different because you are evaluating much more the founder, the market, the potential market, especially for the future, in the product. From our standpoint, so from where we invest, so looking at Series A, B, and C in general, you also need some proof points or more proof points in terms of revenue. We typically say we look at startup when they are in the scale-up phase, meaning they created a product, they found the product market fit, and they are now looking to scale. So we do require, for example, revenue growth. In the question we try to reply is, how do you scale this business to something that is working and maybe has 2, 3, 4 million revenue to something that can generate 100 million revenues? And these days, the reality is that there is a much more focus on what's your path to profitability in the long term. Are the unit economics working now? Will they work in 12 months' time with the investments that you do? In general, how you are being more conscious also about the burn, which is much more relevant.
Anything to add from your lens and how you're looking at investments? You guys were also early investor in Sonder, right? And obviously, could we say that you have now pivoted more towards the technology side of the business than the supply side of the business?
Yeah, I think that's fair, Simon. I think that, what I would add to what Virginia is saying is capital efficiency has come back in a really big way for venture capitalists. I think that I'd encourage you to go look at a chart that's floating around the internet. It's sort of Instacart sort of returns to investors, and basically what I'll summarize is that post-Series B, every single investor did not outperform the S&P 500. This is a $3 billion revenue business that also raised about $3 billion in capital. So compare that with Klaviyo, which was another recent IPO. Those guys had maybe spent $15 to $20 million to become a $7 billion difference. So that tells you the drastic difference between investing in a software business versus an operating business. So as a venture capitalist, the bar is that much higher for us to want to invest in a capital-intensive business, given how dilutive a lot of that capital is. I mean, right now I'm seeing a lot of short-term rental operators raising money like Limehome, Bob W, State Yukio. These guys are raising, $50, $60 million per round, and even if I get in at the earliest stages, my equity is probably going to get diluted by the time they really get to scale. So really, what is my return there? So again, it's really challenging, I think, to invest in an operator unless they can really prove something different. And that's kind of what I was alluding to before. I haven't made any investments in the operating space yet, besides Sonder a while ago. But I'm looking at these PropCo-OpCo structures and how that might be able to create, say, like a Marriott of the short-term rental space in the United States, for example.
That'll be an interesting one. Maybe Viadi Group is the next Marriott in the vacation rental space.
Who knows? I mean, I think we look at that from we're looking for smaller, profitable businesses with, either they're founder-led, where the founder is looking to exit after a few years, and we feel that Yeah, you know, we feel that over that time together with the founder we can bring in management, or maybe they've already made that transition and have people running the business that we can partner with. But of course, because we're investing you know, a small pool of our own money with a little bit of external financing, so you know, we have to look at it and say, can we get payback from this within 2 to 3 years from the operating business? So it's quite different in terms of what we're looking to get out, but hopefully that will compound the ecosystem that we create with the several businesses we have.
So I want to move towards cost of capital as well, which obviously is rising too. Cost of capital has become a huge issue also for the larger private equity funds to actually finance large deals because cost of capital has become so expensive. So that means for you at the Viadi Group, you're not really exposed to that because you finance most of your acquisitions through your own cash.
Yeah, so the 2 of 3 acquisitions we financed out of our own cash flow, and 1 we took external financing, so acquisition financing, but at considerably lower rates than where it is, I think, in the UK at the moment, where I wouldn't want to guess, but I'm guessing it's getting close to 10% or whatever it might be. Yeah.
So 10%, what does that mean to the transactions going about, and how do you look at the private equity market? I'm moving on a little bit from the VC lens, which I think we understand, also from a capital standpoint and a dilution standpoint when you make such investment, to Phil's point. Where do you see that heading? There's obviously some large ones, one in the room as well, who's looking maybe to exit, and you've mentioned Sykes, you mentioned Travel Chapter. There's obviously Aways as well, and maybe some others in the US too.
Yeah, I think cost of capital is clearly a big driver for PE, given the cost of debt has more than doubled over the last 18 months or so. So what was 500 basis point margin over SONIA, which is LIBOR, the new LIBOR being about 5-6% in total. Now we're talking in the 11-12% territory for cost of debt. So if your cost of debt has doubled, your cost of equity also has to increase. So overall, your cost of capital has gone up. So if the issue is the bigger the target, the bigger the deal, the more debt you need, and that makes it almost prohibitive. I think it's very different at smaller end, small mid-cap end, where companies can do more things, all equity, or Bill and Virgin's case, in VC end, it's a different story. So yeah, larger transactions are being disadvantaged and starved because of the issue around debt financing. But yeah, we're seeing their activity certainly in the smaller end. That again, more travel tech piece, where people are happy to do things majority equity with limited debt. But in reality, I think the large transactions will need to be in an environment where interest rates are stabilised, and that's anyone's guess as to when they'll be.
But how does that fit? Like the investors at the moment sitting on unprecedented amount of cash, right? So the capital that is out there to be deployed is actually significant from earlier times, right? So, and they need to deploy that capital. Does that mean they would potentially take higher risks as well in terms of equity versus debt financing, or what do you see there?
So I think it's you've got this dilemma where you've got a lot of private equity funds who are sitting on massive war chests and raised huge amounts of capital. They're also sitting on assets that they need to sell at some stage. What we're finding at the moment is the bid-ask spread between companies that own a company that makes widgets here, they value the business at this level because they've invested at those levels in the past, and they're bidding for widget-making companies at this level because they're thinking there's too much uncertainty there. So there is at the moment there's too much of a gap between what seller expectations are and what buyers want to levels they want to invest in, and we just need a period of transparent, sort of basic stability. Stability in terms of interest rates, stability in terms of trading. If you take vacation rentals and this market in particular, from Sally's data earlier, there's so much volatility in the numbers, and we're seeing this year, staycation now being replaced by revenge travel, and everyone wants to go overseas. So I think that we just need a period of stability, and then once everyone's sort of set as to, right, this is the new valuation, the new norm, then I think there'll be more transactions to follow.
So putting the lens onto the VCs now, Are you continuing to raise capital? Are you opening new funds? Are you deploying more capital on existing investments? And then the third question would be, how are you seeing valuations evolving?
Yeah, so I think we're on our fourth fund. We're not currently raising the fifth one yet. I'm sure we will, but that'll be in some time. We're about, like, I'd say like 30% deployed, 40% deployed. So we're still actively investing in the space. I mean, we've been not so active, I think, in the last 12 months. It's been a kind of slow deployment cycle, at least compared to years past. And I think generally, to answer your valuation question, I think that we've started to see valuations kind of at a trough or plateau a bit. I don't want to call a bottom, absolutely not, but I think that it's been sort of hovering over this like 5 to 6 times level in terms of forward revenue. I'm thinking software valuation, and ARR. That's what it's been since about Q4 of 2022 now. It's kind of floated between that, but yeah, I think that would answer.
Is that the reason why you didn't invest into Hostaway, right? Viadi, you want to have a go at that? How do you guys look at the market?
We are also the fund 4. It's a 450 million fund we are investing from, and we are a bit over midway there. So we'll raise Fund 5, I guess, at some point next year. We have slowed down compared to the past 12 months, the new investments, but if you look at the volume of investments, it's approximately the same, because we did some reinvestments in our existing portfolio companies. Valuation point is interesting, especially because we are a generalist fund, so we can invest across a variety of sectors. Travel is one of them, but we see also other sectors. So it's interesting, for example, to see how the AI companies want valuation really above the 20 times revenue. On the travel tech side, if you look at comps like Airbnb or SiteMinder, they still trade at 8 times the revenue, which is quite healthy. And the reality is that tech-enabled business are trading better than others. The Hostaway, for example, in PSG transaction, or if you look at Guestline M&A, it's still quite healthy multiple. But there is a more fight for quality from a VC perspective. So every time there is a company that is performing well, has good founders in a great market and good unit economics, the multiples are higher compared to the average. But if you look at the average, I would agree with the 6-7 times. But for deals that are, let's call it hot deals, it can go up to 12 to 13.
Excellent. So let's move on onto the property management side, the operations side. Also, when we talk about, I guess, valuations, I get asked this question all the time, and we've seen some extreme examples. Obviously, Sykes has managed an exceptional valuation with Truven Capital, and then we've also seen obviously a lot of add-on deals, smaller deals. And then I tell people, you know, we see any multiple between 3 and 13.5 on EBITDA, right? So Oli, you want to take this on and maybe share with the audience how you view valuation with the businesses that you're looking at to tug in.
Yeah, I mean the smaller businesses that we're looking at are sort of anywhere from 2.5 times to 6 times generally on sustainable EBITDA. Of course, I see the same valuation range as you, up to sort of the 13, and you know there's certainly some of the expectations that people have had when they come towards us. Some may be not so realistic, but I mean there's several factors that we look at when we go into that. I mean where the competitors are in their space, how they're set up in terms of operating once the owner managers leave, if they're still in situ, which is most likely in the businesses that we're looking at. If they have some exclusive properties, so we don't focus on sort of property management with agency, you know, so those properties may be with third parties, but an exclusive sales and marketing mandate for those properties is obviously more valuable for us. So you know, there's some of the points that come into it, and then of course we getting into the more contentious issues in our deal making around the retained earnings, and in the businesses that we look at, they tend to be quite a lot of retained earnings because the founders are using that as a nest egg for the future. And then also things like when the revenue is recognized, we're very conservative, and we've always only recognized revenue on the checkout of the guest, whereas a lot of them are doing it on deposit, obviously. And that becomes a big thing, especially if there's a longer lead time to booking, because then if we do a transaction and we're waiting 12 months to actually recoup the revenue that we thought we were going to get, that becomes a big thing on valuation. Yeah.
So you prefer to do a lot of earnouts as well, retain the people?
Retain the people, do an earnout, maybe keep them invested with a minority position would be preferable in that. But of course, when they're joining a group of companies, that's sometimes not what they're wanting to do as well in sort of one of the vehicles. Yeah.
Now, looking at that, and as we said, you've been part of some of these transactions. How do you let's talk about property management here for a second, right? It's like operating PMC business. It's a tough business. It's hard to scale. And when we talk about valuations, where do you see things heading, and what will be the result of that?
So I think on valuations generally, it's fundamental down to cost of capital. So cost of capital is a function of risk, and as Henrik alluded very well this morning, the world at the moment is at a peak risk almost in terms of volatility indexes, all those things. It's very volatile right now. So yeah, overall, if risk is higher, cost of capital is higher, then valuations need to come down. So if anyone wants to sell in today's market, they must be really, really hot and flight to quality, as Virginia mentioned, in order to try and command a premium valuation. Most of the advice is to wait until things are stabilised to get a more normalised value. But in today's market, because of the risk issues, lack of conviction from buyers, that will impact attention in the process. Valuations will be impacted. I think, as I said before, I think on the PMS, PMC side, I think that's a really area of disruption potentially for companies to come in to do more, because I think they're talking to a lot of hotel operators and other operators. They feel frustrated by the technology that's on offer, and that if they could do X, Y, and Z, there is space for new entrants to come into the space, which is why it's good to see that there's quite a lot of new startups in this space.
Could we also say that in times of uncertainty that people are now thinking of just getting out because of it as well?
I think for private companies, they may be frustrated that it's taking so long, especially if you've got an owner business that they've got no succession plans. That makes sense. But right now, I think where there's a window of opportunity for trade and consolidation, because PE is a little bit disadvantaged because of the debt side. We are seeing a bit more trade interest in guest lines, for example, being sold to Access. I think that's where they can use synergies to have an advantage.
So let us move on, and you just gave me the segue for that in relation to hospitality. So let's elevate maybe to sort of 50,000 feet. All of us are in travel tech and hospitality in some sort. And talking about times of uncertainty, that also brings opportunities, because obviously hospitality companies need to rethink. Has the consumer behavior changing? How is travel changing? We talked about sustainability earlier as well, which is fundamental. We talked about AI. I want to talk about hospitality conversions as well. I mean, hotels have been sniffing around and making some investments or trying to build brands. How do you see, maybe Oli, I want to start with you first. How do you see, with the changing of consumer behavior, with the change of distribution, with the OTAs having all the inventory on one platform, how is the supply? Is the supply converging? And does that mean we're going to see more players within the short-term rental industry as well?
Sure. I mean, I think from the standpoint I come at it from, with in the high end, let's say, take average booking value 20,000 a week plus. I think there will always be. It's a very easy industry to enter, right? It's low cost. You can go to Ibiza and set up a villa company, for $100. I mean, it's what I did originally with Alpine Guru. We set it up and we incorporated a company, did a deal, and went from there. So very low barrier to entry. So I think there will always be new companies coming in, and I think a lot of those businesses are lifestyle businesses. So you can go and be in a certain geography and do that successfully. At the high end, the consumer always values speaking to someone who's on the ground in that place and who they view as a real specialist. So, whilst there is brand loyalty to if you take the hotel entrance into the space, I think there will always be the space for, your trusted advisor who navigates you around that industry.
Virginia, you're nodding your head. What do you see in technology? You're invested in amenities and some others, and I think the lines have been very blurry between hospitality tech businesses and STR tech business. What do you see? Because it's quite interesting. We don't see a lot of traditional hotel tech companies coming to the STR space, but now you mentioned news before as well, and others, cloud beds, are going at it. Do you see convergence there from a technology standpoint?
Yes, for sure in the future we believe there will be more convergence, and I think following COVID, the COVID pandemic in general, there were different problems announced. If you look, for example, at staff shortages, if you look at the sustainability piece, if you look at giants like Google trying to enter in the distribution space, I believe all of this is creating convergence because the problems are different but pointing in the same direction. So yeah.
Phil?
So I think Muse definitely is trying to eventually get into the STR space if they're not already playing in that. So I agree that there's going to be a lot of convergence. I think one space I'm particularly interested in is distribution tech. I think there's a lot going on there. I think that kind of deserves its own panel, so not to leave you on a cliffhanger. but I am writing a white paper on this, so I'll release that. I'm extremely fascinated on the changing landscape of distribution in hospitality and travel, particularly on the lodging side. It's basically a duopoly between Booking and Expedia, and then Airbnb comes in on the STR side. So it's been that way for about 20 years, and I think we might be on the cusp of some of that changing, maybe.
Yeah, and especially because if I might add on that, if you look, for example, at property managers or small properties, they don't have any power with the Booking.com or the OTAs in general, because they go there with 1 properties or maybe 10 properties, but they are not able to stipulate contract, and we all know that the fees that the OTAs offer are quite high. So in the future, what we expect connected to the distribution side is what about players that have 5,000 properties, 10,000 properties, or even 50,000 that go directly to the OTAs to ask some,
Discounts.
Exactly. That's what it is like.
Now, you can wrap this up. From your lens, how is the M&A market as a whole within short-term rental going to evolve in the next 12 to 18 months?
So right now, I think we're towards the trough in terms of M&A volumes, but I think what's pleasing to see is that a lot of institutional capital that's coming into the sector for the right reasons. I think it's a huge opportunity still, I think, globally, that institutional capital needs to be recycled, right? And that will always lead to M&A and Series B, Series C, and IPOs, and take privates and takeovers. So I think with more institutional capital coming in, that will fundamentally mean that there will be more M&A going forward. And yeah, I think all of these funds who are sitting on transactions who can't sell in the last year or two will need to sell in the future because the fund maturities, debt maturities will come up. So yeah, there will be catalysts. I think people are just waiting, but I'm pretty sure next year will be a very good year.
Thank you very much, ladies and gentlemen. Virginia, Oli, Phil, and Nam, thank you very much.